Welcome to a new video where we dive deep into the world of higher than average dividends, providing a steady stream of income video so far and want to see even more helpful. Well, exchange-traded funds, or ETFs, are baskets of securities that trade on an exchange just like individual stocks. They offer a simple and efficient way to diversify your investments. But here's the kicker. High-dividend ETFs are a particularly interesting breed within this realm. They focus on companies that reward their shareholders with higher-than-average dividends, providing a steady stream of income that can be a game-changer for your financial future. It's like having a golden goose that keeps laying eggs. But in this case, it's dividends we're talking about. So whether you're a seasoned investor or just starting out, high-dividend ETFs are worth exploring. In this video, we will explore the top 5 high U.S. dividend ETFs that you should consider for your portfolio in 2025. What's up, everyone? If you're enjoying the video so far and want to see even more helpful tips, tricks, and inspiring ideas, make sure to subscribe. By hitting that button, you'll stay in the loop with all our future uploads. Plus, we'd love to hear from you in the comments. Don't forget to share this with others who might find it useful. First on our list is the Schwab U.S. Dividend Equity. SCHD is its dividend yield. With a low cost can significantly enhance your returns over time. Option for investors. The focus on large cap stocks. But let's not lose sight of the bigger picture. Invest and your risk tolerance before diving in. SCHD Index. This index is comprised of high dividend yielding U.S. stocks. Let's delve a little deeper and take a look at what makes SCHD stand out. One of the key features that investors find attractive about SCHD is its dividend yield. With a trailing 12-month yield of around 3%, it certainly stands out in a sea of low-yielding opportunities. That means for every $100 you invest, you could expect to receive about $3 in dividends over a year. Now let's talk about the expense ratio. An expense ratio is essentially the cost of owning the fund. SCHD boasts a low expense ratio of just 0.06%. In the world of investing, every fraction of a percent counts, and this low cost can significantly enhance your returns over time. Peeking into its holdings, SCHD's portfolio is well diversified with a focus on large, stable companies. Its top holdings include some of the biggest names in the business world, such as Pfizer, IBM, and Procter & Gamble. With such a high-quality portfolio, you can expect a level of stability in your investment. But let's not forget the pros and cons. On the pros side, the low-cost and high-quality portfolio certainly make SCHD an attractive option for investors. The focus on large-cap stocks adds an extra layer of stability, as these companies tend to have more robust financials and are better equipped to weather economic downturns. However, this focus on large-cap stocks might also be seen as a con, depending on your investment goals. If you're a more aggressive investor seeking high growth, you might find SCHD's portfolio a bit too conservative. Moreover, the fund's focus on the U.S. market might limit opportunities from international growth. But let's not lose sight of the bigger picture. Investing is about balance, and SCHD provides a fantastic option for those seeking a mix of income and stability. While it does have its cons, the overall pros of SCHD make it a strong contender in the world of high-dividend ETFs. So if you're looking for a fund that offers high dividends, a focus on quality, and a low expense ratio, SCHD might just be the right fit for you. But like any investment, it's crucial to do your own research and understand your risk tolerance before diving in. SCHD is a strong choice for those seeking high dividends and a focus on quality. Remember, your investment journey is unique, and the perfect ETF for you depends on your individual financial goals and circumstances. Next up is the SPDR S&P Dividend ETF, Now let's talk numbers. IBM. These are companies that are not just big. SDY may not offer the same level of diversification as some options. So, is SDY right for you? Competitive dividend yield, and while it may have a higher expense, holdings have to have increased their dividends for at least 20 consecutive years to even qualify for inclusion. This sets the bar high and ensures that the fund is packed with companies that are not just stable but growing. Now let's talk numbers. SDY has a dividend yield of about 2.5%, which is quite competitive when compared to other dividend ETFs. Its expense ratio is around 0.35%, which is a bit on the high side. However, keep in mind that with SDY, you're getting access to a very specific subset of companies that have proven their ability to grow dividends consistently. Its top holdings are a who's who of blue-chip companies, including AT&T, Procter & Gamble, and IBM. These are companies that are not just big, but have a history of delivering solid dividends to their shareholders. This makes SDY an attractive option for those looking to invest in reliable, income-generating companies, but like any investment, SDY is not without its downsides. As mentioned earlier, its expense ratio is a bit higher than some other dividend ETFs. While this might not be a deal breaker for many, it's definitely something to keep in mind. Also, because of its focus on dividend growth, SDY may not offer the same level of diversification as some other ETFs. The fund's holdings are heavily weighted towards sectors like financials and utilities, which can be more sensitive to economic downturns. However, despite these potential drawbacks, SDY still offers a lot of value. Its focus on dividend growth means that it's packed with companies that have a proven track record of delivering returns to their shareholders. And while its expense ratio may be higher than some, it's still competitive when compared to other investment options. So, is SDY right for you? Well, that depends on your investment goals. If you're looking for a fund that provides a solid dividend yield and has a focus on companies with a history of dividend growth, then SDY could be a great fit. But remember, it's always important to do your own research and consider your own financial situation before making any investment decisions. To sum it up, SDY offers a solid option for investors looking for reliable dividend growth. It's packed with high-quality companies, offers a competitive dividend yield, and while it may have a higher expense ratio than some, it offers a unique focus on companies with a history of increasing dividends. So, if you're in the market for a dividend ETF, SDY is definitely worth a look. Third on our list is the Vanguard Dividend Appreciation Fund is for those who value consistency and sustainability. Their resilience and ability to generate profits over time is primarily invested in large cap yield. It's for the investor who wants to invest in provocation of a high yield fund, but for the patient investor, immediate high yield, but rather about the potential for longer term dividend growth. It's like planting an orchard. You may not get a lot of fruit in the first few years, but with care and patience, the harvest can be bountiful. This fund is for those who value consistency and sustainability over immediate gratification. Now let's get into the numbers. The dividend yield for VIG is modest, which is to be expected from a fund that prioritizes dividend growth. The expense ratio, on the other hand, is quite low. This means that more of your investment goes towards growing your wealth rather than paying for the management of the fund. The top holdings of VIG are a who's who of corporate America, companies that have proven their resilience and ability to generate profits over time. These companies have a history of increasing dividends, demonstrating their commitment to returning value to shareholders. But it's not all sunshine and rainbows with VIG. One of the potential downsides is that since it focuses on companies that grow their dividends, the overall yield may be lower than other dividend-focused funds. This could be a drawback for investors who need immediate income from their investments. Another potential downside is that VIG is primarily invested in large-cap stocks. This could limit the fund's growth potential compared to funds that also invest in smaller, faster-growing companies. However, this focus on large-cap stocks also makes VIG less volatile, which could be a benefit for more conservative investors. So, who is VIG for? It's for the patient investor who is willing to wait for their investments to bear fruit. It's for the investor who values stability and sustainable growth over high yield. It's for the investor who wants to invest in proven companies that have shown their ability to grow dividends over time. But like any investment, VIG isn't for everyone. It's not for those who need immediate income from their investments. It's not for those who want to take on more risk in hopes of higher returns. And it's not for those who don't have the patience to wait for their investments to grow. In conclusion, VIG is a suitable choice for those seeking dividend growth rather than high yield. It may not provide the immediate gratification of a high-yield fund, but for the patient investor, it has the potential to provide a steady stream of increasing dividends over time. And in the world of investing, slow and steady often wins the race. Fourth on our list is the Vanguard High Dividend Yield for their generous dividend payouts. These sectors search of consistent cash flow. Another Johnson, JP Morgan Chase, and Procter & Gamble potentially introduce additional risk into an investor's portfolio to a wide range of high-yielding U.S. companies, which includes U.S. companies that are characterized by higher-than-average dividend yields. The ETF's focus on high-yield dividend payers means that it typically leans towards sectors that are renowned for their generous dividend payouts. These sectors include, but are not limited to, financials, healthcare, and consumer goods. One of the main attractions of VYM is its impressive dividend yield, which is currently around 3%. This is higher than the average dividend yield of the S&P 500, making VYM a compelling choice for income-focused investors. What's more, the ETF makes its dividend payments to shareholders on a quarterly basis, providing a regular income stream that can be a boon for those in search of consistent cash flow. Another advantage of VYM is its low expense ratio. At just 0.06%, it costs just $6 per year for every $10,000 invested. This low cost can significantly enhance net returns over the long run, especially when compounded over several years. Now let's talk about the top holdings within VYM. The ETF has a diversified portfolio of around 400 stocks. Some of its largest holdings include blue-chip companies such as Johnson & Johnson, JP Morgan Chase, and Procter & Gamble. These are solid, well-established companies that have a history of paying reliable dividends, further enhancing the appeal of VYM. However, like any investment, VYM is not without its cons. Its focus on high-yield dividend payers means it has a significant concentration in certain sectors. For instance, it tends to be heavily weighted towards the financial sector, which can be more volatile and susceptible to economic downturns. This sector concentration could potentially introduce additional risk into an investor's portfolio. In addition, while VYM's high dividend yield is attractive, it's worth noting that companies with high dividend yields can sometimes be less growth-oriented. This means that while you might receive a higher income from dividends, the potential for capital appreciation might be somewhat limited. In conclusion, VYM is an excellent choice for those seeking high dividend yield at a low cost. It's a well-diversified ETF that provides exposure to a wide range of high-yielding U.S. companies. While it does have some sector concentration and potentially limited growth prospects, its attractive yield and low expense ratio make it a standout option in the world of dividend ETFs. As with any investment, it's important to consider your own risk tolerance and investment goals before diving in. But for those on the hunt for a solid income-producing ETF, VYM certainly deserves a closer look. Last but not least, we have the Fidelity High Dividend EV is its attractive dividend yield. As of services and healthcare, this broad exposure for growth. However, it's also important to consider it has a significant portion of its assets in certain EV is a promising option for those seeking high yield, and this index is designed to reflect the performance of stocks of large and mid-capitalization dividend-paying companies that are expected to continue to pay and grow their dividends. One of the key attractions of FDVV is its attractive dividend yield. As of the time of this video, the ETF boasts a dividend yield that's considerably higher than the average for the category. This high yield, coupled with a reasonable expense ratio, makes FDVV a compelling option for income-focused investors. Now let's talk about FDVV's holdings. The ETF holds a diverse array of companies with a focus on those that have a strong track record of paying dividends. Its top holdings span across sectors, including information technology, financial services, and healthcare. This broad exposure helps to provide a level of diversification, which can be beneficial in mitigating risk. One aspect where FDVV shines is its focus on quality. The fund's index methodology emphasizes companies that are expected to have sustainable dividend payments, which can be an indicator of overall financial health. This focus on quality, coupled with a high yield, can make FDVV an appealing choice for investors seeking a balance of income and potential for growth. However, it's also important to consider some of the potential drawbacks of FDVV. One such drawback is its relatively short track record. The ETF was launched in September 2016, which means it hasn't been around as long as some of the other funds we've discussed. This shorter track record can make it a bit more difficult to assess the fund's long-term performance and reliability. Another potential con of FDVV is its sector concentration. While the fund does offer a level of diversification, it has a significant portion of its assets in certain sectors. This could potentially expose investors to sector-specific risks. In conclusion, FDVV is an intriguing option for those seeking high yield and potential for growth. Its attractive dividend yield, focus on quality, and reasonable expense ratio make it a compelling choice. However, like any investment, it's important to consider its potential drawbacks and to ensure it aligns with your individual investment goals and risk tolerance. FDVV is a promising option for those seeking high yield and potential for growth. So there you have it, the top 5 high U.S. dividend income and long-term capital growth. Following that, we explored the Vanguard high dividend yield importance of diversification. Not a moment to appreciate the unique features that each one offers. Starting with the Schwab U.S. Dividend Equity ETF, or SCHD, we were introduced to an ETF that aims to track the performance of high dividend-yielding U.S. stocks. It provides an excellent opportunity for investors seeking a mix of high dividend income and long-term capital growth. Next, we discussed the SPDR S&P Dividend ETF, SDY, which targets companies that have consistently increased their dividends for at least 20 consecutive years. It's a solid choice for those wanting a steady growth of income over time. Then we delved into the Vanguard Dividend Appreciation ETF VIG that focuses on companies with a record of growing their dividends over time. It's a great option for investors looking for a balance of income and capital appreciation. Following that, we explored the Vanguard High Dividend Yield ETF, VYM, which is designed to monitor the performance of high dividend-yielding U.S. companies. It's a strong contender for investors wanting to prioritize income over growth. And last but not least, we looked at the Fidelity High Dividend ETF, FDVV, which targets high dividend-yielding U.S. companies. It's a remarkable choice for those seeking an income-focused investment strategy. But remember, while these ETFs have their strengths, it's crucial to understand the importance of diversification. Not all eggs should be in one basket. The key is to spread your investments across various assets to mitigate risk. Additionally, personal research is vital. It's important to assess your financial goals, risk tolerance, and investment timeline before deciding which ETFs suit your needs. Remember, investing is a journey, not a destination. Don't forget to subscribe, like, and share this video to support us. Until next time, happy investing.